Firstly, on the loan forbearance, in Vietnam, they do not have to classify loans that are restructured due to COVID as non-performing or provision against them. And that's in place until 3 months after the Prime Minister declares the pandemic to be over. So for us, we think that's definitely in place this year, and were there to be any signals of any kind of cliff effect in provisioning, we could see further relaxation, but only if necessary. How has that helped the banks? Well, the banks' non-performing loan ratios are generally low compared to a lot of emerging markets across the region. I think that's firstly, there's some question marks over the quality of the reported numbers and whether they are somewhat understated. And that's been a problem that's been around pre-pandemic, and we take that into account when we rate the banks. The second point's been that Vietnam, as Sagreek has mentioned, has actually continued to grow during the pandemic. It's one of the few markets in APAC that's managed to do that. And that's obviously helped the banks. They've had loan growth. It's also meant there's also been lower unemployment, and that's kept provisions slightly lower. We did see provisions at the banks spike last year, but some of that's more preemptive, given that the NPL ratios have remained lower, and we expect that to remain elevated but come off this year. It's a similar story across the region in terms of elevated credit costs this year. Some will be more elevated than others. I think for the Vietnam banks, generally with the economic recovery, that should be very good for their profitability in terms of keeping their credit, giving people longer pay as the economy recovers alongside the regulatory forbearance.